Welcome to our call for this April-June quarter results. I wish we were doing a repeat performance of last year April-June quarter on current volumes. That would be the day. If wishes were horses, then we would surely be riding them. Let me get on to the first of the wish list, demand. Cement demand, I believe, is coming back, and this trend we noticed more than a year ago. Housing has been and will always remain the biggest demand driver for cement. But in this cycle, infrastructure-led demand is taking cement consumption up, and with the improving infrastructure, a natural extension is improvement in the housing demand, which we believe should start off in the next 2 to 3 years. There is a moderate shift at present from individual housing to institutional housing. And I have mentioned in the past also about this being the biggest upcycle for cement. Historically, cement cycles have been 3 to 4 years, but we believe this being the longest upcycle that the industry is witnessing, because this time around, the demand drivers are different. We expect the momentum in cement demand to continue with some big projects around the annual. I understand work on Jewar Airport, that is the New Delhi Airport, coastal roads in Mumbai, Purvanchal Expressway on the Allahabad-Gorakhpur sector, Mumbai-Nagpur Expressway will commence before the end of this year. The long overdue Mumbai Airport also is expected to commence work now. Land leveling has been completed and the contracts have already been awarded for the construction of the airport. Polavaram Dam in Andhra continues in full swing. All these are very large projects. And this time around again, government has introduced penalty clauses and delays beyond the deadlines given for completion of the project. Hence, there is a strong chance of systematic and time-bound execution. The recent MSP hike will further help improve the rural demand. Of course, this is bound to create inflationary pressures in the economy. Rural markets has been a very strong forte of Ultratech. Today, we have nearly 36-37% of our sales in rural markets. I stand corrected, it's now up to 40%. Low-cost housing and affordable housing consistently are supporting cement demand growth with increased pace of execution. Since April 18, I am told fresh construction work started for another 1 million houses in urban areas, the low-income houses. And construction has already been completed about 0.4 million houses in the last 3 months. In rural areas, about 500,000 houses have been completed during the last quarter and sanctioned about 2 million new houses. Total sanction till now is about 8.5 million houses. Government is fast reaching its target of at least sanctioning the 10 million houses per year that we had envisaged. Further to update, the first phase of DFC project is also likely to commission by the end of this year. For Western Freight Corridor, which is 432 kilometers out of the 1,500 kilometers, and Eastern Freight Corridor, 343 kilometers, is likely to commission. This is important not for cement consumption, but to improve the logistics for cement, improvement in rail availability in the Eastern Corridor, which is absolutely dry as far as cement industry is concerned for rake availability. Movement of cement becomes extremely difficult these days in the absence of availability of rakes, because rakes are diverted for government requirements. The growth and improvement of infrastructure in the country will lead to a general improvement in housing demand. Additional capacity from new assets acquired has given us an opportunity to expand our footprint into newer markets and in the institutional channel. With pan-India presence, we enjoy a very high share of business for cement sales amongst all the leading infra companies who are catering to the low-income housing projects, catering to the infra projects, and urban housing as well. This quarter, our domestic volumes have grown 34%. The quarter saw strong demand across all regions. In our view, we could see double-digit growth for the sector in this quarter, for sure. For Ultratech, blended sales have gone up 3%, now at about 67%, and trade sales, being in the focus, have now risen 2% to 68% over the previous quarter. Let me get on to the next wish list, the next of the horses of the wish list, which is prices. I would compliment our own team for achieving this growth without compromising on prices. The realizations on an average have gone up 1% to 2% quarter on quarter. However, the exit prices have been far higher than the average prices for the quarter across all zones. As compared to previous quarter, central and western markets saw a good improvement, followed by north and south, which were lower than Q4, but the exit prices, as I mentioned earlier, were higher. East was muted or remained flat. Full benefit of June price hikes should reflect in the current quarter, since the exit June prices were higher than the average. The next area which I would want to touch upon is our costs. Our costs have increased about 3% quarter on quarter. Petcoke, coal, diesel have not shown any signs of slowing down in terms of costs. Rupee depreciation is also impacting the import bill. Another dimension to watch now is the interest cost, which seems to be inching up. This could be a dampener on new capital spending, new expansions that seem to be mushrooming. The plans seem to be mushrooming as of now in the country. We are focusing on reducing the impact of increase in purchase price with efficiency improvement. During this quarter, the purchase price impact was about 13% and efficiency gain was about 2% in our direct manufacturing cost. Mind you, this improvement of 2% is a sustainable, long-term, permanent reduction in cost. And I believe the purchase price impact, whilst today it is high, in the long term it is not sustainable, and there will be a tipping point when costs start coming down. With the current cost of petcoke at some of our locations, coal is becoming economical. Our total usage of coal, both in kiln and power plants put together, has increased to 16% during this quarter as compared to 11% in the same period last year. Amidst the adverse cost scenarios, there is one good news for the sector. In the last few days, the government announced the new norms for axle load for trucks, increasing it by 20-25%. This will surely benefit the logistics costs. There was some confusion that the axle load is allowed only for new trucks, but however, a clarification has been issued that the axle load increase will be the older trucks will be eligible for the improvement in axle load. We will see how the benefit starts impacting the P&L in the future quarters. Another element, whilst the focus is always on operating margins, we run a large treasury, which forms, and the treasury income forms part of our overall EBITDA. This quarter, since the yield curve has gone up, it resulted into an M2M dip in our treasury income, because of which the overall EBITDA would also look slightly down. Let me now share with you an update on our sustainability agenda. 5 new projects are under commissioning for WHRS, which will take our WHRS capacity to 121 megawatts, meeting about 15% of our total power requirement. We expect them to be completed by in somewhere in the financial year 20. We have increased the consumption of alternate fuel to about 4% of our total fuel and are working on further increasing it. We are now certified as 2.18 times water positive by a global quality assurance and risk management company, DNVGL. I wouldn't know the full name, so don't ask me about it. Let me touch upon the acquired assets. almost a year has gone by. I think 12 months of operations now. We completed the acquisition on 29th of June 2017. Our focus has been on cost optimizations this quarter, and we should be able to achieve the optimal level of cost from all the acquired plants post-monsoons. A couple of plants are under shutdown right now, after which we believe that costs will be at par with our existing plants, excepting, of course, the structural costs, which are the MMDR royalty and logistics costs, because some of the plants are landlocked or far in locations. Total variable cost difference today is around 160 per metric ton between the two sets of plants, the acquired plants and our existing plants, out of which there is scope to achieve efficiency improvements to the extent of rupees 50 per ton, which is remaining now, and 110 will be the structural difference. We are confident to complete our improvement plans by December 18. These assets were operating at a very low level of capacity utilization when we acquired them at somewhere around 18%. We completed the acquisition at the start of monsoon months last year, and also sand mining bans were hitting the country at that point in time. This led to a forced suppression of demand, and our focus has been to increase our capacity utilization of the acquired assets without compromising on prices. We have successfully increased the capacity utilization across the network, and the plants are now stable at around 70-75% capacity utilization. A lot has been said, and I have read about increasing supply. We expect the supply to moderate around 3 to 4% every year, whilst the demand growth will be around 8 to 10%. Faster pace of demand growth than supply would result in narrowing of demand-supply gap and gradual increase in capacity utilization. Historically, if you scan decades of history of cement industry in the country, every time when the cement demand has started booming, supply has also increased. This is nothing new. However, this time around, what we are looking at as the gap between demand and supply, demand will certainly be far higher than the supply. The moderation in supply would be primarily be driven by continuing cost pressures for key input items such as coal, petcoke, and oil, as well as costly mines in the long run. Also, the rising interest rates will increase the overall financing cost for new capital outlay. On our own home front, we have already completed our 3.5 million ton of capacity greenfield capacity at Dhar in southwest MP. The Bara grinding unit of 4 million tons is under execution. Work has picked up pace, and we expect the plant to be commissioned by Q4 this financial year. CapEx spends during the quarter were about 330 crores, and balance to be spent for the year is roughly around 1800 crores. We had also announced the merger of cement business of Century Textiles with Ultratech. We expect the transaction to be completed by Q4 FY19. FY19. After all the regulatory formalities. CCI application has already been filed. It is under review, and we expect CCI clearance by middle of August. And thereafter, the legal formalities of court-convened shareholder creditors meetings, filing with ROC, etc. And in between, there are court holidays, because of which the transaction will see a closure only by Q4 of FY19. White cement-based new putty capacity expansion of 0.4 MTPA is also on track. This is expected to commission by FY20. Let me talk about our own cash flows, since it's a high focus area right now. Net working capital has increased by about 568 crores, essentially with the buildup of raw materials and fuel inventory. This is typical for pre-monsoon period. During this quarter, our net debt has reduced by about 208 crores and now stands at 11,799 crores on the Indian balance sheet. Net debt to EBITDA is around 1.75x, and the ROCE has marginally inched up to 10.4% on the basis of Q1 annualized. That is all that I had to say, and in the end, I've heard a lot about anxieties about the cement sector, saying that demand is rising, prices are not rising, etc., etc. But I believe that the fruits of patience are always sweeter. There are no secrets to success, and it is the result of preparation and hard work, which Ultratech is well known for. Thank you so much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is on the line of Gunjan Pratyani from JP Morgan. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Just one quick clarification. Firstly, you mentioned the difference between the cost of the JPA and the ex-JPA assets at about 160, right?
Yeah.
And the difference is all cost, or this 110 of MMDR is included in this?
Yeah, 160 includes 110 of MMDR and extra logistics.
Okay, so the incremental cost saving or cost reduction would be about 50 rupees
yes.
over the next 2 quarters?
Yes.
Okay, and just to get clarity on this roadmap to PBT break-even, now we are already at cash break-even in this quarter, right?
Yes, please.
And from here, of course, the cost reduction of 50 will come through in next 2 quarters.
Yes.
But I think from a perspective of reaching PBT break-even, there will be more needed in terms of EBITDA per ton increment.
Absolutely.
So is this banking on the debt pay down, or the roadmap is contingent on pricing improvement? Just want to get clarity there.
It's a mix of both, Gunjan. There is continuous focus on debt repayment. Last year we had reduced 1,600 crores. This year about 200. This year first quarter 200 crores already down. However, today when we are at about 70-75% capacity utilization, this capacity utilization will go up. One of the plants is under a long shutdown for environmental improvements. ESP is being converted to baghouse. That's statutory requirement. So once all the plants are fully up, the capacity utilization will also go up. And with this increasing demand, the buoyancy in demand, I believe the prices are bound to rise further, helping us improve EBITDA. Second thing also which will help Ultratech improve its EBITDA for the acquired assets is, fast change in the ratio of trade, non-trade sales and blended sales improvement.
And that should also yield some realization.
Yes, absolutely. So there will be a mixed effort. It's not just realization by itself.
Okay, and would you be okay to comment on what will be the EBITDA per ton difference? Because, of course, we can work out the calculations given at a cash break-even, but any sense you can give us what will be
difficult to say that, Gunjan.
Okay. Secondly, on just on these results, the fiscal incentives seem to be higher. So any specific reason why there is more accrual in this quarter, and how should we look at the remainder of the year?
One is it's directly linked to volumes and prices in the markets where the plants have fiscal incentives. This will go up further when there's one plant where incentives are due. I believe that should get cleared. Bela should get cleared next quarter. City, huh? So we would expect clearance on another set of incentives for the. It's already provided for. Sorry. So this is all due to volume and realization mix as of now.
And this should stay as a run rate for the rest of the year? Because this has risen pretty sharply versus what we were reporting until even Q4 of last year.
We have to wait and watch. It's a mix. Suppose the volumes go up in Western markets and on an average, then the incentive mix will not be visible as much.
Sure. Just one last question, I'll join back the queue. On the lead distance, you mentioned there's been improvement sequentially, but anything you can comment on versus last year? Because last year, 1Q, we didn't have JPA with us. So versus
Q1 last year sequentially, Gunjan, it's not sequentially, it's year on year.
Okay, what will be the lead distance now?
About 240. How much? Sorry. 427. What am I saying? 427 or 429 kilometers there.
Okay, got it. I'll join back.
1 year ago. Now it's about 427.
Okay, got it. I'll join back the queue. Thank you so much.
Yeah.
Thank you. The next question is from the line of Indrajit Agarwal from Goldman Sachs. Please go ahead.
Thank you for the opportunity, sir. Sir, two questions. First, on petcoke prices, can you give us some idea as to what was the average rate for the quarter?
$110 was... $114 was the average for this quarter, and current trading is happening at around 119.
All right, that is helpful, sir. And second thing, on any update on your aspirations in the northeastern market, anything that you can share at this point?
No, when I have an update, I'll come back officially.
Sure. Thank you. That's all from my side.
Thanks, Indrajit.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Hi, sir. Morning.
Morning,
other expenses, compared to December quarter versus March quarter, we always seen that the other expense declined. But if I even compare to December quarter, given the volume increase that we've seen versus December, our other expenses were absolutely lower than the December quarter.
This is all linked to maintenance costs, which would, surface. There's no fixed pattern on maintenance costs.
So let's say you commented that in December quarter there was 30 crore JPA related shutdown costs. Even if I adjust for that, despite a 10% increase in volume versus December quarter, absolute other expenses were lower than that.
Wish you have anything to say.
Other than maintenance, there is some slight difference in advertisement cost. So which very depends on...
Yeah, so my colleague here tells me there will be some element of advertisement costs, in this quarter or vis-a-vis last quarter.
But that would be...
Nothing unusual.
That gap will be only 10-15 crores, right? That's it, right?
Yeah.
So there is nothing unusual.
There's nothing unusual. It will be, I don't remember anything unusual. No.
Okay. Second thing you mentioned, the exit prices are higher. Just one question that if you take those prices to sustain at the higher cost of petcoke and freight, your contribution, excluding the fixed costs, you will still be maintaining the contribution today, what you had in the June quarter?
Let me give you an analogy on this. The average prices went up about 1 to 2%, and variable costs have gone up about 13%. EBITDA per ton has improved quarter on quarter.
Quarter-on-quarter cost is 3 to 4%.
Sorry, I stand corrected. Quarter on quarter, the costs have gone up about 3%, 3 to 4%, and prices have gone up 1%. Prices have risen only in the month of June. So, if we are able to sustain these prices in the entire quarter, then obviously we should be able to do a good EBITDA. However, April, June, July-September quarter is a maintenance period. Maximum amount of maintenance work is undertaken from on account of during the monsoon period. But as you mentioned on contribution, yes, contribution levels will be maintained.
You will be able to
I don't foresee a challenge over there.
Okay. And so the last question on the freight benefit you mentioned on the truck load bearing capacity being increased. Any initial assessment? Let's say we are
doing it at the moment, Anubhav. Earlier, when the first circular was out, it was not really focused because it was about new trucks. Now the subsequent amendment talks about old trucks also, and there are various categorizations, 20-tonner, 38-tonner, and 25-tonner. That's already published. So we are analyzing the fleet and how fast we can get the benefit of that.
But just a rough idea in the sense that the benefit can be low single digit in terms of reduction in freight costs, or can it be higher than mid single digit?
I'll keep my fingers crossed. I'll take a target of low single digits only. But if higher is available, good for us. I don't have any computation, hence I'm not able to comment on it right now.
Okay, sure. Thank you, sir. This is helpful.
All right.
Thank you. The next question is on the line of Rashi Chopra from Citigroup. Please go ahead.
My questions have been answered. Thank you.
Thank you. The next question is from the line of Murtuza Arsiwala from Kotak Securities. Please go ahead.
Yeah, hi, sir. Just wanted to check, the Dhar capacity has been ramped up fairly aggressively compared to what we've traditionally known, a more slow ramp up. Is it a reflection of the underlying demand growth, or Ultratech continues to sort of, sell ahead of peers and gain market share like we saw with the Jayaprakash acquisition where you've grown much faster than the industry? So is the ramp up still reflective of...
Why can't you compliment us for doing something good?
Sir, I'm just trying to get a clarification whether it's the good work that you're doing versus peers, or industry volumes have also improved.
No, I think Dhar is a shining example of Ultratech's capability, the technical team's capability. First and foremost, the execution of the project from the groundbreaking to commissioning of the first line in a record 354 days, cost being controlled, and the ramp up. So, of course, ramp up is... we wanted to do a ramp up earlier also, and the demand has also supported.
All right. Thank you so much, sir.
All right.
Thank you. The next question is on the line of Amit Murarka from Deutsche Bank. Please go ahead.
Yeah, hi. Good morning.
Morning.
So just first a data question. So what was your white cement putty volume and revenue included, and RMC as well?
White cement...
3.31.
3 lakh tons of white cement. Putty is included, yeah. Sorry.
1.5. RMC here, 400.
White cement revenues is about 400 crores. RMC volumes is about
12.5.
Revenues is 507 crores.
Okay, great. And just then a question related to the annual report actually from me. So just noticed the production mentioned was 57.23, but the sales in domestic sales have been 59.3. So there's a 2 million ton additional sale versus cement production. This is I'm talking about. So I guess this is what the tolling arrangements have increased.
Yeah, there are lots of tolling arrangements which we keep trying. Short term versus long term. If there are opportunities available, we do that.
Okay, it's not that the clinker sales have increased, right?
No. Nobody will sell that much of clinker.
Right. Great. And just some clarifications on the regulatory issues. I believe there's a Supreme Court hearing wherein the Oil Ministry has kind of supported the petcoke import ban. Now I think the Environment Ministry has to respond. So what is your sense on that?
No. As far as I understand, the Supreme Court judge asked or has asked the Petroleum Ministry to file their report, and since they are delayed, a 25,000 rupees fine has been imposed on the ministry. However, the ministries have maintained, and I've seen this order also, and I'm sure you have also seen the order and heard the Supreme Court ruling or the Supreme Court arguments that both cement and steel are allowed to use petcoke. So import ban is not being discussed as of now. It's more about because the Supreme Court judge was talking about the pollution and pollution and the related issues with petcoke. Import ban is not there on the anvil.
Okay.
And we are pretty confident. It is that beats all logic. When India is deficit in petcoke, then why would you ban imports?
Right. And the other worry also, I think, is that the Reliance petcoke gasifier is almost complete now, so the domestic availability of petcoke would also probably reduce.
Yeah, that's true.
Right. And any update of the Rajasthan sand mining issue? I believe there's a court hearing pending on that as well.
Rajasthan, I believe, is the only state where there are still some issues left to be sorted out. But by and large, it is not impacting the construction activity because sand imports from neighboring states is happening at the moment in the state of Rajasthan.
Okay. And lastly, can I just get the fuel mix and OPP, PPC, PSC mix as of now?
I had mentioned it. OPC is about, blended is 67%. And what else did you ask? Petcoke is about 75%.
75% of the kiln.
For kiln.
Okay. And balance 25% would be what broadly coal then? I mean, 4% is AFR. Yeah.
Coal is about 20% and alternate fuel is about 4%. 4%,
yeah. Okay, great. Thanks. That's all from my side. Yeah.
Thank you. The next question is on the line of Suraj Yadav from CLSA. Please go ahead.
Hello. Good morning, Atul sir.
Yes, Suraj.
This is Vivek. So my first question is again on freight one. So while you said, about the calculation that you will have to do, but just conceptually, this will only benefit your output or there can be some benefit on the input side also, as in when you, fetch raw materials or when you fetch gypsum, fly ash or coal?
Yeah, both sides.
Both sides? Because I thought inputs will be more volume dependent and therefore, there is a limited potential to increase the tonnage over there.
No, there are open trucks also which are used for imports. And earlier, before this relaxation, the government had put penalties on the buyer if the trucks were loading extra. So a local miner would tend to load extra, but the buyer was a handicap. So there was a lot of restriction on inbound logistics as well. This will get eliminated to the extent of whatever is the allowance.
Okay, so the benefit will be on both the sides, input as well as on the output.
Yes.
Okay. Second is on the cement pricing, where the exit prices are compared to where the, let's say, spot costs are. Is it still, pushing up margins or you are just maintaining what the levels were?
Pushing up margins. And as I mentioned, if you were to exclude the July-September quarter, because July-September quarter would be heavier on costs, everything else remaining the same, October, December, if you were to observe, it will push up margins.
Okay. And obviously, I don't have the detailed numbers, for let's say, different revenue line items. But if I remove operating income and look at grey cement realization, it doesn't look like on a sequential basis there is hardly any increase. Is that correct or no?
Sequentially, about 1 to 2%.
No, sir, but if I remove operating other income, which has fiscal incentives and a lumpy one, actually there is no increase in sequential realization. Is that not correct?
Sorry?
I'm saying if I remove the fiscal incentives or let's say operating other income.
I look at my fiscal incentive is not part of my billing. So okay. If I look at my average billing is higher.
Okay, for the quarter you are saying?
For the quarter, about 2%. QOQ is what I'm talking about. Of course, not YOY.
Sure. So you are saying underlying grey cement realizations are higher on a sequential basis.
And more important, so this was, I'm sure you guys can do your maths. The price hikes were taken during June and multiple points in time in June. So you don't have full month effect of June, and this is, as I'm repeatedly saying, the exit prices are higher.
By how much?
Good question.
Could you quantify on a serious note?
Obviously, I will not want to tell you. That's why I don't want to quantify.
Okay. And lastly, your outlook says with the cement industry now in its upcycle, demand is expected to be healthy. So, demand is looking like to be more of an outcome because cement is in an upcycle. What do you mean by that, exactly? Because when your volumes are rising, let's say 30%, there is hardly any change in EBITDA. So, upcycles are not characterized by that. How would you respond to that?
I wish I was Shakespeare, Vivek, to capture words properly. But the point that I'm trying to make is cement as an industry will see volume growth, very high volume growth, long story short. Second one, again, from our perspective, I don't know about other players in the country, but from our perspective, our focus was to ramp up the capacities of the acquired assets, which we have been successful. And wherever we found opportunities to increase prices, we have taken price hikes.
Okay. So upcycle obviously should also mean better margins, right? Is that how one should look at it? Yes. Because this quarter, you say it's a start of an upcycle, but numbers are not showing that is what I'm trying to say,
I know. So what is happening is this time around, the costs are also ramping up very fast. Whether it is petcoke, I don't have to repeat that point, but all these elements which contribute about 65% of our costs are going up continuously. The low on petcoke, if you will recall, was January-March 16, about $41 to $45. Today, it is hovering around $119. Okay, coal is at 101 or 102, anywhere around $105 actually. Diesel prices, crude is stable at $75. Rupee is depreciating. This is causing a far higher impact on costs. Small hikes in prices are enough to take care of these costs, which has been again visible in this quarter. Because if you see that this marginal hike in prices, let's say 1 to 2% in this quarter, and the total cost increase of about 3 to 4% over the previous quarter has helped improve the EBITDA per ton marginally over the previous quarter. So our forecast is, and if you look at any, what is Argus? Argus is so there is an agency called Argus who publishes data on coal and petcoke. If you look long, 2 years long, the prices are being forecast in a downward trajectory. All right, so costs will come down. It cannot go unabated the way the costs are going up on petcoke and coal. There are global phenomena. There is an Aramco IPO, if you were to ask me, that also is linked to crude prices. There are several other phenomena which we can discuss offline, which are keeping the prices at these levels.
Okay, but my point is, wherever the costs are in an upcycle means that you should be able to pass on all the impact and should still grow the margins, right?
Absolutely. It will happen.
Okay. On that positive note, wish you all the very best, sir.
Thank you, Suraj. Without agreeing.
Thank you. The next question is on the line of Naveen Sahadev from Edelweiss. Please go ahead.
Hello.
Hi, Naveen.
Hi, sir. So my question...
Speak loudly, please.
Yeah, is it better now?
Yeah, it's better.
Perfect. So, my question was now from a market share perspective, having acquired JP assets, Century is also on its way, and hopefully even Binani. So, from an overall market share perspective, from here on, how do we see expansions in the sense that do we look at maintaining market share expansions for Ultratech to maintain market share, or there is scope, and of course the company is aspires to increase it further?
So today our capacity is 88.5 plus 4 million tons of Bara, which will take it to 92.5, plus roughly 14, I'm rounding it off, 106.5. That divided by about 460 million tons gives us about 23% capacity share. Ultratech believes in profitable growth. So, and there is no end to profitable growth. We will want to increase our market share and profitability alike.
Fair. So in the sense that expansions, in that sense that because a lot has been talked about, expansions as you mentioned in your initial comments, trying to understand that our expansions, including that of Pali, so that can be followed with expansions which are targeted at growth higher than the industry to further increase market share, or?
Yes.
Okay, fair. And my question was again on the JP assets. Are these assets having waste heat recovery plants, or is there a... Sorry?
No, not yet. We will take them up now. Currently, we have 5 plants under execution, as I mentioned. And we will take up the waste heat recovery plants in the acquired assets also in due course.
So the 62 which is planned, new waste heat recovery of 62 megawatt which is planned, that is at JPA?
No, existing plants. So it is at Kotputli, which is in Rajasthan, Dhar itself. There is Hirmi, which is in Chhattisgarh, GCW Gujarat plant, and one plant in Andhra.
But there is scope to, you saying, put it for JP acquired assets also, right?
Definitely.
So is the payback...
Older the plant, more the opportunity for WHRS.
So my question then, sir, is that if, the payback period typically, as we understand, for waste heat recovery projects is being very high, what is it stopping us to, have these waste heat plants at JP Associates in...
Very simple. Here I have 2 arms and 2 legs. So management bandwidth is required. So we will take it up. We don't want to, whether I put it up over there or put it up in our existing plants, there is bound to be efficiency gain and improvement. Return on investments will be there.
No, sir. I was only saying since the cost difference is that 50 rupees, which is, you said, can be bridged, and there is some element of structurality of 110 odd. I'm saying waste heat recovery could give us another 20, 30 rupees there, I think.
Yeah, so we will take it up. Since these projects were already, planned and, conceived, the work has already commenced on them. The team is, I believe, working on the plans. So assessment is happening right now. My colleague from the JP assets, acquired assets tells me. The assessment is happening and it will be put up to the board for approval.
Okay. Yeah. And, one last thing. Pali, what is the timeline? Have we ordered equipment for this unit? Pali expansion, I'm saying?
Not yet ordered, but we will start. The commissioning is June 20. That's what the target is.
Okay. Fair. Thank you. That's it from my side.
All right.
Thank you. The next question is from the line of Sanjay Parekh from Reliance Mutual Fund. Please go ahead.
Hello? He's not there.
As there's no response from the line, we'll move to the next question. That is from the line of Rajesh Lachani from HSBC. Please go ahead.
Yeah, hi sir, thanks for the opportunity. Sir, 2 questions. Can you just give me what is the demand growth in each of the regions and what was our utilizations in these regions?
Our utilization north would be somewhere around 80%, central about 70%, east 95%, west about somewhere around 75%, south somewhere around 60%.
Okay. And sir, demand growth in these regions would be?
Demand growth, how do I estimate that? It's very difficult for me to comment on demand growth on an individual region, Rajesh.
Okay, sir. Not a problem.
Yeah.
Thank you. The next question is from the line of Kamlesh Chen from Prabhudas Lilladher. Please go ahead.
Yeah, thanks for the opportunity, sir. So, with regard to this Pali expansion or the greenfield plant, somehow it's the feeling which we are getting that it has been postponed. Earlier we were talking March 2020. Now even the equipments have been not supplied. So, what's the actual thought process on the plant in terms of adding capacity in the Rajasthan? Or is it a thought that we would first want to complete this Binani and then we will give a thought to that?
No, there's nothing like that. North market is so buoyant that we have to do our Pali project. We are running fully sold out, almost fully sold out. Binani, if it were to happen, it will help us meet the growing demand of Rajasthan and the northern markets. So both, there's nothing. We are committed to a March or June 20 deadline. That should not be a problem.
Okay. And so, just one question on this incentives part. Like say, some of the incentives would be getting expired, like say for the HP plant. So, what should be the steady rate or per ton rate we should look into? Because in this quarter, it has been as high as around 105 rupees per ton.
Very difficult to compute that, because as I was mentioning on the call earlier, it all depends upon the mix of sales volume from region to region and the realizations that are happening in that particular high prices and low volumes will still lead to lower incentives.
Okay. But sir, your breakup among the incentives as well, so it would be more contributed by your western region, like say the Maharashtra plants, or it's equally distributed among the regions?
It would be more or less equated, because incentives are now on SGST for sales within that state. So the rate of incentive is the same. Somewhere you might have one-off additional incentives like electricity duty. Somewhere exemption is available and so on and so forth. But the biggest standard incentive is an exemption on SGST for sales within the state. So that ratio remains the same. It's only directly linked to the volumes then.
And so lastly, say, what's the guidance on the capex part in this year and next year?
This year we've already completed about 300 odd crores of capex in Q1, 1800 crores more to go. And next year I would have about 2,000 crores as of now.
Okay. Great, sir. Thanks a lot, sir.
Thank you.
Thank you. The next question is on the line of Anshuman Atri from Premji Invest. Please go ahead.
Yes, thank you for the opportunity.
Sir, can you speak a bit louder, please?
Yeah, I'm saying thank you for the opportunity and good performance in a challenging time. So my question is regarding recent ministry talks on bringing the royalty payment under GST. So will this change the economics of the acquired plant and bring it at par with the existing one?
Why not? It will, no?
It's additional royalty.
No. So, acquired plants, there is one more level of royalty which will continue. But if this happens, then I think the margins and everything will... I will not... I'll stop coming to the office and go and play golf, that's all. So if it happens, it will be wonderful for the industry.
Okay. And secondly is on the coal. For example, for the past 1.5 years, we have not seen any auction, and all the captive producers would like to have So, for example, Ultratech requires so much of coal. So, what do you think is why are these coal auctions not happening? And would you
I recently read a notification announcing the next set of coal auctions. We are examining if there's any mine of interest to us. We had one coal mine in auction in 2015, which we are working on commissioning, which should start production in now somewhere in 2020 or 2021.
Okay, so and preference would be a linkage or a captive coal for Ultratech?
Sorry?
The preference for Ultratech, will it be a linkage or a captive coal mine?
Preference is linkage coal.
Okay. Got it, sir. Thank you.
Thank you. The next question is on the line of Anupam Goswami from Stewart & Mackittich. Please go ahead.
Hi, good morning, sir. Just want to know one question, that what is your cost usage on petcoke and what is your cost usage on coal?
I'm sorry, what is the cost?
Cost per ton if you use on petcoke, and what is your cost per ton on coal?
Just 1 second.
On energy basis, petcoke cost is about 1 rupee 30 paisa, and coal is about 1 rupee 45 paisa.
For 1 ton, right?
1 kg on in energy terms.
1 kg. Okay. And sir, if you I must have missed in the beginning, if you could give the prices trend in for all the regions of India, like how much it has risen or it has gone down from the previous year?
Just 1 second. So if I were to look at quarter on quarter, the prices have better percentage movement. So central is about 4 to 5%, west is again 4 to 5%, east is flat, north is about 1% up, and south is, I would call it a flat only.
Okay. And sir, on an overall basis in the longer term, where do you see your sustainable margins at? Because it has sharply fallen, and can we see anything improvement in the next 2 years maybe?
Yeah. So today we are at, let's say, 20% margins. Instead of talking about EBITDA per ton, I'll switch gears to percentage. Today we are at 20%.
Yes.
I think this is the lowest levels of margins. We should see improvement in margins in the coming years.
Okay. That's all, sir. Thank you very much.
Thank you.
Thank you. The next question is on the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Good morning, sir.
Morning.
So you indicated of good demand, and actually we are seeing it across the region. But you also mentioned a good demand-supply equation. So when we are reading reports or when we are hearing from companies, everyone is looking for expansion and even the ordering activity is picking up. So what is your sense of supply side? Because demand looks strong, but supply side, you're seeing reports of 25 to 27 million addition for next 3 years. Versus less than 20 million tons for last 3 years. So can you throw some light here about your understanding of ordering activity?
It's slightly higher than that, maybe close to 40 million tons over a period of 3 years, which is around 10% growth in supply. All right. And the demand is expected to grow at about 8 to 10%. I would be bullish on a double-digit mark. Even if 8 to 10%, average 9% growth, which is 27% growth in demand over the next 3 years. So current demand is roughly around 275 or 290 million tons. 290 million tons, that is potentially set to grow by about 27%, which is roughly 78 million tons. And the new capacity basis announcements and board approvals and orders placed anywhere between 40 to 45 million tons is the supply which will get commissioned during the next 3 years. So to that extent, supply-demand gap will be shrinking.
So you are indicating you expect 40-odd million tons over the next 3 years?
Yes.
Whereas the consensus is building towards upwards of 20 million per year. So that's a number of 60 million.
That's wrong. That's totally wrong.
Okay. So I think we have to do some more work on that.
Yes.
But I think if your number is correct, then I agree with your assessment. Thanks a lot, sir. Yeah.
Thank you.
Thank you. The next question is from the line of Madhav Marta from Fidelity. Please go ahead.
So just one question on the demand side. You're saying 8 to 10%, and probably if you're bullish, it could be higher.
Yes.
In the history, if I look for the last so many years, and now we're at a higher base, also of 300 million tons versus, say, 100 in the last upcycle that we saw. So what makes you bullish on getting that 10% number? Because on a 300 million ton base, and with urban housing, private capex not looking that great, how do we see that demand coming through? Because 10% seems very sharp. I mean, I'll be happy if it comes, but what are the drivers that can... Because infra is not a very big part of overall India demand, right?
Very good point, Madhav. My colleague just told me yesterday that FY12 or FY10 FY10 was in the history of cement in India, FY10 was the highest demand growth in volume terms, about 12.1%. Okay, that's anecdotal. Now, why 10? Of course, I don't remember what was the base in FY10 and absolute growth number. So you're absolutely right that on a higher, today it's a higher pace of 290 million tons. Let's say 300 million tons also rounded off, and 10%, 30 million tons of demand. Now, where is this demand going to come from? All these infra projects that we are talking about, some of them I enumerated on the call as well. I'll build on examples. The bullet train project, it will consume additional 1 to 1.5 million tons of cement every year. There is a rehab project for the BD Chawl in Mumbai. It's a 12,000 crore project. That's a massive cement guzzler. The highways, now cement roads were not being done in the earlier bull cycles. Cement roads are happening now. Okay, the metro project where we are one of the biggest suppliers in Mumbai, the sales are going up currently somewhere around 15,000-20,000 tons, will go up post monsoons to about 30,000 tons a month. So these are, so 30,000 tons does not equate to a 30 million tons, I understand that. But the point that I'm trying to make is all these projects, and these projects are on a time-bound execution plan. Government is levying heavy penalties on contractors for any delays. The Worli Ceiling project, which took 7 years, 8 years, I don't know how many years and how many extensions, those kind of delays will not be permitted now. So this time around, the heavy-duty consumption of cement is what is going to drive demand. The Purvanchal Expressway, which is one of the longest ones from Allahabad to Gorakhpur, one of the longest expressways that is being done. The Bharatmala project, encompassing all these concrete road projects, 84,000 kilometers of roads. The low-income housing project, which is now picking up pace. I again repeat that the affordable housing program has not yet kicked off in its super speed. I am in touch with some developers, and the organized real estate is gathering steam now because of RERA. People have forgotten that RERA just came in May 17, and only 8 or 10 states have adopted RERA till now. Once the entire country is on RERA, the organized real estate will start booming. We are seeing uptick in urban real estate already. Cities like Mumbai, Gurgaon, Pune, they are seeing, the construction activity and demand for organized real estate coming back. It's a matter of time when the tier 2 and tier 3 towns start picking up pace. I'll give you another example. Gujarat as a state was not growing in demand for cement till about 6 months or 9 months ago. The moment DFC has entered Gujarat, there is so much of ancillary activity which has started picking up that we are seeing huge volumes of cement in Gujarat. State by state, there are different demand drivers which are generating volumes. Rural markets, we keep forgetting about the rural markets in the country. Rural markets are the largest markets in the country. First and foremost, there was this crop loan waiver. Now the MSP hike which has come in. Monsoons have been good consecutively for the 3 years in a running. The demand from rural markets has started picking up big time. So all this is leading to the 8 to 10% growth. Last 3 quarters, we have seen 13-14% growth in cement industry. It is happening.
Okay. So just one quick follow-up to that. So in terms of pricing being better, you mentioned that, we'll also try to increase our retail institutional mix. But many of these will be institutional projects, right? Infra plus the low-income housing. So do you think that could be, that could not help margins a bit? Would you agree with that?
We have seen price hikes in our institutional clients, for our institutional clients also. And because, there is only this much of cement that is available. Whilst we talk about 72% capacity utilization, or 72% overall? 73% overall capacity utilization in the country. There's a lot of dead capacity also in the country. So there is bound to be price improvements from institutional customers also, which we are already seeing ourselves. And more important than the price is the margin, because there's a lot of cost which is eliminated in institutional supplies. So margins are fairly robust.
Right. Okay. Right. Thank you so much, sir.
Thank you. Ladies and gentlemen, due to time constraints, we'll take our last question. That is from the line of Ashish Jain from Morgan Stanley. Please go ahead.
Hi, sir. Sir, so my question actually pertains to the last point you made. Today, what is the kind of EBITDA per ton differential you see in your institutional versus non-institutional business?
Difficult to go down to the EBITDA level on, so if our average EBITDA per ton is 929, give or take 20-30 rupees here or there, that's what I would estimate.
Okay, fine. And so secondly, the spike in incentive income that we have seen this quarter, is it from a specific plant? And if yes, can you just highlight which plant is it?
So the new plant which started generating incentives was Dalla, part of the acquired assets. But more important is the mix of sales and prices which have started to improve the other incomes or incentives.
Okay. And so just, as a side point, so there has been a newspaper article, now this pertains to Binani, that as per the terms of the bid that you have given, you are incurring 1.5 crores of interest costs on a per day basis. Is it possible for you to comment on that? And, is that how the deal is?
The matter is sub judice. It's in court, so I don't want to delve on that at the moment.
Okay. Thank you, sir. Thanks so much.
Thank you.
Thank you. Ladies and gentlemen, that was our last question. I now hand the conference over to Mr. Atul Daga for closing comments. Thank you, and over to you, sir.
Thank you, everybody, for participating in this call. The Q2 July-September quarter, let me warn you up front, don't have high expectations in terms of margins because it's a wet period. volumes, I still hope the way the construction activity is going, volumes will sustain and prices will sustain. However, with higher maintenance cost during the quarter, you could see some kind of a depression in margins. Otherwise, this seems to be a beginning of a good year and a good period for cement. Thank you so much.